What's up, guys? Today I want to talk about just the basics of investing and where somebody might want to start if this is seeming a little bit intimidating for them and they feel like there's just so much information to take in and they don't know where to start. I understand that's the case for a large majority of us. And just trust me, like taking this first step and looking into it and trying to figure out information, you're doing yourself an amazing service. So thank you so much for watching. I'm also going to answer a bunch of common questions that I get as far as the different types of investment vehicles and decisions that you should make and benchmarks and thresholds as far as fees and things like that I look into when making my certain investments. And all the things that I'm about to discuss, I talked about in detail with my co-host, JJ Buckner. We just started a podcast called the Average Money Podcast. This will be featured in episode 5. So if you haven't taken a look at that, consider taking a look and looking at some deeper details of the things I'm going to talk about today. So when doing my consulting and talking to people, the first thing that I talk about is debt. Now, debt needs to be a part of your investment journey. There are all different types of debt. There's good debt, bad debt, consumer debt, car debt, student loan debt, credit card debt, you name it, there are types of debt. And I'm pretty firm when I say that if you have any sort of consumer debt, you should probably pay that off before you start investing. I had a little bit of a debate with somebody last week. They had a bit of credit card debt and they're like, Brad, I have a 0% interest deal until June. It's only $1,300. Why can't I just pay it off? And, I want to invest some money. And the simple answer is A, if that's what you want to do, go for it. But how many people do you think last January had a 0% interest deal on a credit card and opted to invest instead of paying that off? Well, what happened between then and June? Right? Their investments lost over 30% and still haven't recovered yet. They might have lost their job or their income might have been changed. Then they would have got to June. They weren't able to pay it off initially. So now we're at June. Their offer is over. Their now interest rate has doubled. Like, you see where this is snowballing. You can come up with every single excuse you want not to pay off debt before you invest. But with the exception of the employee match, which I'm about to speak about in a second, there is really no reason, in my opinion, to ever start investing before you pay off your consumer debts. Consider that debt payment an investment in yourself, which is really the first place you should always invest, in yourself. Now, I just mentioned that employee match, and that's really the first place I'm going to look to invest. Why? It's free money. Inside your 401k, most companies are going to give an employee match. You put in some money, they put in some money up to a certain amount. And that's really the first place I'm going to look to invest. Even with high fees, it's still free money. Now, when looking at the fees, that's when we're going to decide if we should move past that employee match and contribute on top of that or not. But if you have a 401k plan with an employee match, I highly recommend having that be one of the first places you look to start investing. Go inside your 401k plan, find an index fund, something that tracks the S&P 500 or the total stock market, and that's a good place to start. Put your money in and get that employee match. Then we can start to look forward and see what other options we might have available to us as far as investing. Now, personally, I don't have an employee match. I am a state employee, so I have something which is called a 403b, which is very similar to the 401k, a little bit different, but I don't have that employee match. So for me, the first place that I'm going to invest is inside my Roth IRA. If you have any sort of taxable income, you really should be investing inside your Roth IRA. Now, a Roth IRA is not an investment. A Roth IRA is an investment vehicle. So you're going to go into something like Fidelity, Charles Schwab, Vanguard, and you are going to open a Roth IRA account, and then you are going to put investments inside that Roth IRA. Now, the beautiful thing about a Roth IRA is all of the capital gains that you make, the growth over time, the dividends and things like that, those are going to grow tax-free. And there's a number of other advantages to the Roth IRA, and I've made videos. I'll link some in the description below. But the Roth IRA, an amazing place to start. Right now, as of the recording of this video, it has a maximum of $6,000. If you can't max it, don't max it. Put as much as you can inside there. And once again, I'm always going to advocate total stock market index fund or an S&P 500 index fund. Now, you might be one of those people that makes too much money to put into the Roth IRA. If that is the case, you're going to want to look into something called the backdoor Roth. It's something that I do. What you have to do is you have to put money into a traditional IRA and then just move it and roll those contributions into the Roth IRA. It's a little bit trickier. You have to fill out a form with your CPA, but it can be done. It's totally legal. It's a legal loophole that we all know about and use if you make too much money to invest inside the Roth IRA. Now, personally, I do all of my Roth IRA stuff through Vanguard. I'm a VTSAX fanboy, which is the mutual fund that I like to use. I'll link a playlist to my entire Vanguard portfolio and the things I'm doing inside my Roth IRA. Once you get past the Roth IRA, then we're going to go back and we're going to look at the employee-sponsored retirement plans that we have. Once again, the 403B, the 401k, and in the rare case, the 457. Now, inside these employee-sponsored retirement plans, this is where things get a little hectic and a little bit crazy. And the reason why is they don't really give you a chance to succeed. You go to Human Resources, they give you this huge packet. You say, I want to invest in my 403B, my 401k. They give you this huge, intimidating packet. And then you ask them for advice and they say, whoa, 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 I'm not a financial advisor. Right? And you're like, this is just going to be so intimidating. So you get stuck either going and listening to somebody in the office that knows a guy or whose friend does it, or even worse, you go to some sort of professional development and there's a guy there that's going to help you and give you the great future that you want. It turns out you find out years later after some education, you were really funding his retirement through all those terrible fees instead of your own. If you have an employee-sponsored plan, all right, and this is going to be tax deferred, meaning that you are going to pay taxes on it later, not now, make sure that you're finding something with low expenses, not a lot of percentage of fees, and something that tracks, like I said, once again, just an S&P 500 or a total stock market index fund. The two major questions I get about employee-sponsored plans are, what's my thresholds for fees? And I have a Roth option inside my 403B, 401k, or 457. Should I take that Roth? Well, first with the fees. The fee part, really, it's up to you, but I'll tell you this. I use my effective tax rate for the year before to decide if I'm going to invest inside these tax-deferred accounts. And the reason why is because I am using these tax-deferred accounts to lower my W-2 income and save on taxes. Then I could take that tax savings and invest it somewhere else. Well, if the amount of money that you're paying in fees is more or greater than your effective tax rate, then you're really not getting to take advantage of those tax-deferred accounts. Now, if that's not the case, I'm only going to hit the employee match, and then I'm going to get out of there, and I'm going to move on to other options. That's really how I decide what my fee threshold is. What is my effective tax rate, and what is my effective tax rate going to be in that calendar year? If you have no idea what that number is, just go back and look at your tax return or ask your CPA. If you don't have an ongoing relationship with your tax person, your CPA, your accountant, you need a new one. I talk to my accountant all the time. I pretty much have him on retainer. I probably drive him nuts. But you should have a relationship with them, talking tax efficiencies, talking money that you're making. Establish that relationship, and you can ask them, what was my effective tax rate last year? And they'll show you where it is on your tax return, and then you'll know for future years. Now, as far as should I take advantage of a Roth 401k, a Roth 403b, or 457, I personally don't. Like I said, I use tax advantage accounts to save on taxes. Now, if you are young, maybe in the early stages of your career, and your tax rate is super, super low, then yeah, take advantage of the Roth, right? Because what's going to happen with the Roth is now you can go above and beyond the $6,000 max of a traditional like Roth IRA. Now you can put into $19,500 Roth if you're making a small amount of money and your tax rate is low. Essentially, you're going to pay taxes now at that low tax rate. You're going to take advantage of the Roth 401k, 457, or 403b. Then later on, when your taxes go up, you'll already pay tax on it, and those will be growing tax-free inside that Roth. Now, for me, I'm at the stage of my career where I make pretty much at the peak of what I'm going to be making. My tax rate is about as high as it's ever going to be as far as I'm concerned. So I don't take advantage of those Roths because I want to defer my taxes for later on in retirement when I assume that my taxes are going to be less because my income is going to be less. I'm going to have my pension, other investments, dividends, and things that are taxed at a lower tax rate. So I can safely assume that my tax rate is going to be less later. So I take tax deferred now as opposed to the Roth option. So recapping the steps so far, pay off your consumer debts. Try and get the employee match inside a 401k or 403b. Max out that Roth IRA. Then go back to our employee-sponsored plans if the fees are good enough and work towards maxing those out right now at the current rate of $19,500. Decide where the fees are and, according to your tax bracket, should you be taking advantage of a Roth or just a regular. And remember, if you choose a Roth 401k now or a Roth 403b now, in a couple years, you can always change that. Nothing is going to be set in stone. If you've been a subscriber of mine or know, I'm a big fan of the 457. If you are a teacher, fireman, nurse, things like that, I've made a video about the 457, but just real brief. The 457 is very similar to our 403b. They're actually paired together, and there's two major pros for me. Number one, it adds another $19,500 that I can tax defer. I get my 403b and my 457, and I max my 457 out first because it does not come with the 59 and a half age restriction to take out the money. They have something called separation of service. If I were to retire early, I separate from my job, I can now pull from my 457 without an early age penalty, unlike our traditional, our Roth, our 401k, and 403b accounts, where you have to wait to your 59 and a half. And granted, yes, it's not as simple as that. Like I said, you have to look into fees, your age, your job, things like that. But if you have access to a 457, like I said, I'll leave the link for the 457 video down in the description below. It's the first retirement account that I max outside my Roth IRA. Now we're a bit into this video, and you've noticed that I haven't mentioned individual stocks, a brokerage account, or anything like that first. To be honest, guys, I do all of that first before brokerage accounts. One, I'll say it, right? It is harder to pick individual stocks and win on a long-term basis than it is to be involved in index funds. That's why a majority of my net worth, probably 90% of my investment portfolio, is just index funds. That's it. Now, once I have all those maxed out, do I have a dividend portfolio? Yeah, I have a dividend portfolio with some individual stocks in it. I have some growth stocks. I own Apple. I own Microsoft, Visa, and then some other big traditional dividend stocks, but those are a small percentage of my overall investment net worth. I make sure I take care of everything else first, and the things that are more secure, especially at my age of 38, I'll be 39 this year. Especially at my age, I want to make sure that I have those steadfast things, those things that have been proven over time to grow your wealth the most efficiently, and those are index funds. It's really, really hard to outperform an index. Can you do it? Yes. I can't. I'm not that smart. And that's why I also wait until I'm done with all of those things before I start investing in individual stocks as well, because it's going to take time to max out 401ks, 403bs, Roth IRAs, right? We can't just do that overnight. Everyone starts at zero. So it's going to take some time to build up. While you're building up, you learn about investments and stocks and what analytics to look at. Then you're ready to start picking some individual stocks that you might want to hold a small percentage of your net worth in, to help. Maybe as even a hobby. My dividend portfolio, frankly, it's a hobby for me. I like it. And lastly, I think the most popular form of investing is through real estate. Whether that's going to be flipping houses, whether it's going to be buy and hold, where you're buying a property and then you're going to rent it out, or if you do something like me, you're lending private money out to people that invest in real estate. Like I said, that's what I do. And there's many different types of ways to invest in real estate. But like I said, that's probably going to be the last step in your investment journey. At the end of the day, do not be intimidated by investments. They're your friend. They're going to help you grow wealth. And they can be learned with just a little bit of education over time. But start with that employee match, start with the Roth IRA, that should get the wheels turning, and then everything else will just fall into place over time. Do not worry about doing it overnight. It's not going to happen overnight. Everybody starts at zero. Till I catch you guys on the next ones, stay positive, work really, really hard, and always be kind to other people. Hope you have yourself an amazing day and an even better tomorrow.